Ladies and gentlemen, good day and welcome to Music Broadcast Q1 FY24 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions and expectation of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Ashit Kokian, CEO. Thank you and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining the Q1 FY24 earnings call for Music Broadcast Limited. Joining me on the call is Mr. Rajiv Shah from our IR team and our investor relations partner, Strategic Growth Advisors. I am pleased to report that we have started FY24 on a good note. For the quarter, our revenues grew by 20% year-on-year to 53 crores, with EBITDA growth of 45% to 12.7 crores, resulting in an increase of 420 basis points in operating margins. During the quarter, we've been able to maintain our market share leadership position with 19% market share according to the 15 ad check markets. About 41% of all radio advertisers are served by our company. In Q1 FY24, Radio City secured 37% of the new clients who advertise on radio for the first time. Our dedication to providing high quality content and innovative marketing initiatives has led to this remarkable growth in our audience engagement and reach. We have been at the vanguard of capturing evolving consumer preferences and leveraging technology to deliver an immersive and personalized experience to our listeners. In terms of sectorial aspects, the real estate industry experienced a 24% year-over-year increase in advertising expenditures. The pharmaceutical market expanded by 4%. The education industry made a turnaround and posted the highest growth of 87%. The auto industry grew by 58% in comparison to the previous year. The sectors of electronics and appliances, food and soft beverages grew by 10 and 24% respectively. During the quarter, the digital part of the business grew by 33% compared to Q1 of FY23. We have paved the way for the production of high quality content and increased audience engagement by utilizing our in-house knowledge and expertise. This aligns with our RAD digitalization strategy, which focuses on radio-centric digital connections. The future is set to be digital and radio is no exception. Not only are we aware of the tide of the transformational change sweeping the industry, but we are also at the forefront of RAD digital revolution in India. To provide our listeners with a world-class entertainment experience, we have designed and implemented a cohesive strategy that seamlessly integrates digital with our core radio foundation. We are delighted with the progress we have made in establishing Radio City as the preferred medium for the Indian audience that includes advertisers and listeners. As a part of our ongoing strategy, we are strengthening connect with the diverse regions of India to accurately portray the experiences and expectations. Radio City in particular has been dedicated to providing locally viable content across different languages and genres, striving to create content that resonates with the audience and enhances their lives. This approach has played a key role in making Radio City a household brand across India, distinguished by its unparalleled reach and deep understanding of the consumer market. Radio City has recently launched its new station South, a one-of-its-kind modern version of Rag Rag Mein Daude City, City Ka Naya Vibe to engage the Gen Z audiences. Now, coming to the financial performance highlights for Q1 FY24. Revenue grew by 20% year-on-year to 53 crores. EBITDA grew by 45% year-on-year to rupees 12.7 crores, while EBITDA margin expanded by 420 BPS to 24%. I would like to highlight over here that our operating profit growth have outnumbered the revenue growth. This was mainly on the back of a conscious effort over the past few years to reduce costs, which has paid off, allowing us to take advantage of better operating leverage, which has led to faster rise in profitability. Adjusted profit after tax, which is adjusted for interest on NCRPS to the tune of 1.9 crores, stood at rupees 2.8 crores. Our cash reserves stood at rupees 302 crores as of 30th June 2023. Our liquidity position remains strong, and as stated previously, this liquidity allows us the flexibility to take advantage of the present and prospective future opportunities. To conclude, I would like to say that the changing media consumption habits of the Indian audience, driven by the availability of multiple content options, have created an opportunity for the radio industry to adopt digital platforms while maintaining radio as its primary business function. We at Radio City have made conscious investments in the digital and technology domain to keep up with the current trends. With this, I request the moderator to open up the floor for Q&A. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Forum Makin from JHP. Please go ahead.
Hello sir, congratulations on a good set of numbers. Sir, I just had one question. Just wanted to know about the ongoing litigation that's been going on our at the holding company level. Could you share some light on the same?
See, right now, there is only limited information that is there available, and it's not really playing much on our operations because, MBL has its own operations, which is directly managed independently by us and by the team.
Right, sir. But what is the likely outcome, that you foresee, that you feel will be of this litigation?
See, right now there is only a representation. There is no information beyond that as to, what is the future steps that is going to be taken and so on and so forth. And, it's too difficult for us to predict any change because we have not seen any change, at least as far as our business is concerned. So I think at best we'll have to wait and watch. And there is a professional team which is looking at it.
So, sir, you believe there won't be any impact on the operations of the company, right? Whatever the outcome.
No, and I am not really sure how many days it's passed, but we are managed by a completely professional team, as you are aware. Your company is completely managed by a professional team, which is managing things independently. And so far as we are concerned, so there is no such impacts that we see happening as far as our business is concerned.
Okay, sir. Thank you so much.
Thank you. Before we take the next question, I'd like to remind participants, if you have a question, please press star then 1 on your touchtone telephone. The next question is from the line of Riya from Equitas Investment. Please go ahead.
Hello. Thank you for giving me the opportunity. So my first question would be regards to the advertisement. So how much is the government advertisement for us?
See, government, we have a higher share of government advertising, but if your question is linked to the fact that has the government started investing in the manner we were doing it in the past, not yet, but there is a slight improvement from what it was last year, and we believe in the coming quarters that investment should only grow.
Could you help me with the quantum of the same?
Come again, sorry?
Could you give me the numbers for government revenue?
Right now we have a 5% contribution coming from the government revenues in terms of volumes.
Oh, out of the total advertisement volume.
Correct.
Got it. And in terms of minutes per hour, how much is the current ad rate for us?
See, we are right now at a 70% utilization level, and when you're asking about the ad rates, every station has different rates. So, what exactly are you asking about rates? If it's in comparison to a reference point, then I'll be able to possibly answer your question better.
So earlier I think we had around 20 minutes an hour of basically advertisement. So currently what is the...
It's about 15 to 16 minutes that is currently running, but it again depends, as we move into the peak period, that consumption may increase. Typically it starts with, pre-festive season, it's at a lower level, and during the festive, it increases to an X level, and that's the way the norm of the industry across mediums are.
Right. And in terms of the rates for advertising...
To understand that better, I think a better way to give you an answer is, currently we are at 70% utilization level of the overall inventory. So there is still a space of 30% to grow from a pure inventory basis concern.
Got it. And in terms of yields, what are the current ad yields, like in terms of the pre-COVID level?
So we are still, first quarter, because, the way we are looking at our business is that because the first quarter is usually muted in volumes, we operate pretty much the same operating rate as we exit. And it's only when the festive season comes and when the inventory levels go high, you kind of increase your rates. Yeah. And to answer your question, so we are still at the 70% of pre-COVID rates that we are all seeing at the moment. But I believe this year, as we go towards our festive season, our rate should increase, because that is the common feeling most of our peers also have, because we are all getting into an inventory fixed kind of a situation, and hence the only way to increase revenues post your inventory is taken care of is by increasing rates, and that is something which we all believe will come in sooner or later.
Right, and I think currently government had come up with a particular 200 or 300 stations which they want to auction. So what are your views on that, and how will it benefit us going forward?
Yeah, so too early to comment right now. 808 frequencies is what they are saying they will launch in about 340 odd cities. Our take on this is very clear, that as long as it is attractive enough for us to have a viable business prospect, we will obviously bid for it. Our strategy here is very clear. We are currently dominating in 4 states as far as our business is concerned, and any frequencies that will come in those 4 states, we will obviously go up for bidding. If it allows us to be, profitable, and if there are any newer states where we are not present, and and if we believe that it is good enough or attractive enough from an advertising perspective, we will take, because as you know, your company is cash rich, so we will be able to invest in those areas where we believe there are larger profits to be made.
Right, got it. Currently, what's the debt and cash on the book?
So we don't have any debt on our books. The debt is only about if you see the NCPRS, what we have to give, repay after 36 months, that is the only debt on the books. And the cash is 300 crores, which is there on the books.
Right, and sorry for a very, hello?
Yeah, go ahead.
I want to know where are these NCPRS listed, and where would I find the correct valuation for this year?
It's listed on both NSE and BSE in the debt segment.
In the debt segment. Okay, fine. Thank you. That's it from my side.
Thank you.
Thank you. A reminder to the participants, if you have a question, please press star then 1 on your touchtone telephone. The next question is from the line of Jia Shah from Wealth Securities. Please go ahead.
Sir, I wanted to ask, what is the contribution of the government ad spend for this quarter?
Just 5% right now from a government spend perspective, which is hardly anything. We believe as we get closer to the election year, we will have the government spends increasing.
Okay, all right. Thank you, sir.
Thank you. A reminder to the participants, if you have a question, please press star then 1. The next question is from the line of Virat Shah from Shah Investment. Please go ahead.
Hello. Hi, sir.
Good afternoon.
Yeah, good afternoon, sir. Sir, I had one question. While your revenues has grown by 20% and operating profit has grown by 45%, can you quantify as how much growth has came from volume increase versus the value increase And how much do the cost control measures?
Yeah. So, see, the growth largely in this quarter is come through volume increase, because that's the typical way industry operates. When you have the inventory available, you don't shortchange yourself by trying to go premium and losing out on certain businesses. So that's the first point. And cost control is something which we have been doing for the last 2 years. So all our cost measures is optimized, and that is the way you're looking at the whole equation with a 20% growth and an overall EBITDA increase of 45%.
Okay, sure. Thanks.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. The next question is from the line of Praveen Sharma, an individual investor. Please go ahead.
Yeah, hello.
Good afternoon.
Yeah, good afternoon, sir. My question is on the recent annual report on the other expenses. When I see it, the elaboration is there in the schedules, note 18. I see that there is a significant. There are 2 items which are large. One is advertisement and marketing expense, which is around 28 crores, and then programming cost, which is around 15 crores. Now, what are these? And can somebody explain me? Means 28 crores for advertisement and marketing cost. What is this exactly about?
So the marketing cost is basically the paid and barter investments that we do to promote the brand. The Radio City client.
So this is like, we are, this is like, we are putting up something like 15-16% of our top line for promoting our own brand, correct?
So, sir, the marketing expense also includes the expenses of all the on-ground events which will take place. So that's the reason it will be a little higher percentage.
Because this is, what I find is quite high. Even the FMCG companies don't go in.
Yeah.
We ourselves are advertisers, and we are investing so much.
Yeah. So I will give a little clarification. When we say marketing, with the on-ground events, which is also monetized by the team, is the cost is included here. So, if, for example, very recently we did the Business Titan Awards, which is basically recognizing business achievers. There is a cost involved for the event, but there is a equivalent and more revenue that we draw with these kind of events. Those costs are also included as part of the marketing, though it is a monetizable investment that is happening.
Okay. So pure vanilla advertisement just to promote brand will not be 28 crores, correct?
In fact, very, very little of that, because since we have our own stations, we don't invest in advertising elsewhere.
Yes. And the programming cost, sir, this is.
Yeah, that is content cost. Sometimes you have to use external resources for a specific, for example, when we did this jingle, you need to use professionals to kind of get this done. So it is only those kind of investments which is coming into programming. Otherwise, large part of our programming cost is just the people cost and the content that we devise from the existing talent that we have.
Okay. And sir, the offices, most of the spaces are owned by us, or they are on rental?
No, they are all on rental. Barring only Mumbai office, all offices are on rental.
Okay. And sir, on the depreciation part, there is a significant in terms, depreciation taken on intangible assets, which is, I think, monetization of the, phase 2 to phase 3, one-time entry fee and things like that. Now, once these things expire, say after 7 years, which is mentioned as useful life, do we have to reinvest the entire stuff again? How will it?
You'll have to go.
How does it work out?
Yeah, after 2030, as of now, we will have to invest again in your licensing.
Which means that it's not a free cash flow. It is like, it's a free cash generated, but then you will have to keep it. We need after 6-7 years, or in the recent auction, we will need a lot of this cash to be reinvested in frequency, same assets, again for say 10 years.
Yeah, so which will, the pricing will differ because of the kind of, representation that has happened by the radio industry in terms of the cost. We believe that there may be a positive side to the pricing that will happen when it comes to, the renewal of the licenses. And that is where, we possibly don't know what exactly the investment should be. But, the government seems to be understanding the challenges that the industry is going through. And we believe some positive news will come from that. But that's still time for us, because that's still 7 years away, like you rightly said. But yeah, some part of that investment still will be there. I mean, we can't deny that fact. And as you know, we have been year on year generating cash. So obviously when we reach that period, we will have far greater cash reserves than what we have right now.
Yeah. Suppose we are generating 40-50 crores a year, 32 crore depreciation.
300 crores will be generated.
40 crores. Yeah, so around 300 plus 300 we have, so 600 crores will be there.
Correct.
But out of that, 120 will be going into this debenture payment.
So 500 plus is what you can look at as comfortably. Of course, the math will vary from year to year and from the overall strategic movement that is happening from an organizational perspective. But yeah, if you take that, that's the kind of number you can expect to be having when you end up the period of licenses.
And sir, there are two more questions. One is, how do you see FM radio business panning out after 7 years? For 4-5 years, say, is it a business which is declining or it's a growing business? How do you see it in terms of looking at the alternative media, advertisement media which are available to advertisers also? Your broad view, because you are there in the field and you have fairly long experience. How do you see this, and how do our company seems to be aligning with the the new prospects which are there in the industry?
Yeah, so I'll take this question in two forms. So one is, of course, to ask what is the growth that radio is going to go. I personally believe that even if I don't look at the allied activities that we do along with radio, which is on-ground-led event monetization, digital playout monetization, presence in social media, which is also monetized through RJ influencers and so on and so forth. The answer is yes, radio will see its logical growth that is happening. Whether that growth could be as high as what we have seen in the last 6 to 7 years, absolutely not. But there is definitely a growth that we see in radio. But the way I look at this whole business perspective that we have is that we have evolved beyond just being pure radio. If you see the way we are performing in the last 2 to 3 years, we are doing monetization through on-ground-led events, which is experiential marketing as far as brands are concerned. We are monetizing through our digital presence in the social media world. We were from a 3% last year, we moved to a 8% of share coming from pure digital revenues. So, as that 6 to 7 years, as you rightly pointed out, the radio growth will be one part of the growth. The on-ground-led opportunities that we are creating will be another part of the growth. And the larger growth from a sheer percentage perspective will be from a digital playout which the organization is already seeded in the last 2 years. And hence, the combination of all this still makes it clearly viable for us to be in the business.
So next 5 years, 500 crore is achievable?
Okay. See, 18 to 20% CAGR is something which we are saying I can stick my neck out right now. The exact number will be I'll be able to possibly stick my neck out a year and a half or 2 years from now when my digital playout completely it gives me a sense of what exactly is that we will do as far as the exact number. But one confidence I can give you that within 5 to 6 years, my digital playout will be roughly 35 to 45% of my overall business.
Okay. Great. And the last part is, because of this litigation and all, as an investor, we don't see any issues in redemption, 2 years, 3 years down the line of the, this NCPRS.
Absolutely no issues. Positively speaking, we have always been run by professionals, and that's the reason why I believe there have been no interferences also, and you can be rest assured there will be no effect happening from whatever little the current thing that is happening in the market.
Great. So only one thing was that recently our share was put up in the periodic call auction. So that was a bit surprising for a company like Radio City to get into that. But probably this was because of the issuance of these bonds wherein our price fell subsequently.
Correct. Exactly right. You got that exactly. That's the only reason. There is no other reason that you should be worried about. And that also is another matter of maybe a couple of weeks more that you'll have, already you can trade on all the days right now.
This has been a change. Earlier it was once a week and subsequently probably you guys made a representation. It is all in a week or something.
Yes.
Okay. Great, sir. Thank you. Good luck.
Thank you so much.
Thank you.
Thank you. Before we take the next question, I'd like to remind participants, if you have a question, please press star then 1 on your touchtone telephone. The next question is from the line of Ansh Manek from Equirus Securities. Please go ahead.
Hi sir, good afternoon. Thanks for the opportunity. Sir, I wanted to understand with respect to the government spending. So within the period of next 12 months, the central elections are being lined up. So so what's the company expectation with respect to increase in the government spending in advertising matters?
There will be a substantial increase in government spending for two reasons. Wherever the central government has a state government, they will use the state government to kind of talk about the good things that they have done for the state, which indirectly will also mean a better, central government elections results. So you will see investments happening about the good things each state has done, and that will be the first. So there will be investments happening from state government, and also at the central government level, when you come closer to the election year, you will see that spends will happen from the ministries talking about the achievements that they have done so far in this period of this term of their of being in the government.
Okay, sir. And the second question is with respect to the digital side. So currently, what would be the contribution of digital revenue to the overall revenue?
8% is what our current contribution is.
And we are expecting to reach to 35 to 40% within the period of next 4 to 5 years, right?
Yeah, around 5 to 6 years we should be in that. We would like to surprise you by doing it earlier, but we can be safely saying that that is the minimum that we are looking at.
And what would be the source of revenue for the digital side? So it would be just the advertising revenue from the social media platforms, or are we kind of building any app or platform?
Okay. So, there will be multiple. Right now, what we are doing is we are monetizing our presence in the social media platform. However, as you know, because we are coming from a content-rich background, we are also parallelly creating content. And I'm sure there will be platforms who would value content that they believe that will add value to their platform, like syndication of content. So not just the social media platform, but even syndicating content and creating content for platforms or for creators is something which we are looking at, because we have a lot of resident talent, creative talent, which we would like to exploit. For example, 2 years back we had done the deal with Spotify where we were giving them original content which was commissioned by Spotify with us. So similar options of syndicating content we will be looking at, and we'll be constantly trying to get our monetization done across various verticals that we want to pursue.
So the expenditure or capital realization would be purely on the content side. It won't be on the developing of any app or platform of our own, right?
See, right now, there is no such reason why we believe we should go into an app, because there are other ways of getting your distribution done. As far as the platform is concerned, we are evaluating a few areas technologically in case of increasing our reach, and whatever suitable options come, we will not mind investing in technology if that is the need for us whenever that time comes.
Okay, sir. Thanks for answering my question. That's it.
Thank you.
Thank you. The next question is from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Hi. Thank you for the opportunity. Sir, revenues grew 20% year on year in Q1. So, are we saying that, for coming quarters also we should be growing 20% year on year?
It all depends, how the market performed. But expectations to have between 17 to 20% will be fair, I think so. And because we are building ourselves up to ensure that there is considerable growth in our business. So yeah, we should be looking at that kind of a range, I would say.
Okay, and with respect to margins, so what kind of EBITDA margins do we expect in coming quarters?
See, right now we are at 24% margin, and as you know, this is the kind of average you can expect from us as we go forward. And we'll see, because which I've been telling in the past telecoms also, that there will be some investments that we would want to do as we want to foray ourselves larger digital play that we want. So some investments will happen, hence we'll try and keep our margins within whatever period that we are talking about, and this is something which I believe should be a healthy margin to look at.
Okay, and so regarding the government contribution, which is 5% currently, what was it, during pre-COVID levels?
Pre-COVID it was quite high. I would say it was possibly it was the largest category. In fact, about 10 to 12% was the kind of spends government would have minimum, and election years would be little more than that. So yeah, we are a good way away from, even if I look at the absolutes, from the investment pre-COVID to what it is now.
Okay. So when we say, sir, that, we are expecting to grow like 20% year on year, are we building the additional government spends into it? That are we building that, the government spend will be from 5 to 10%, 12% something?
See, as you know, the percentage of growth is usually a combination of our pure business, which is the radio business, which government is also part from a category perspective. We are also talking about on-ground led for monetization. We are also talking about digital. So in the combination, I am talking about 70 to 20. The playout will be depending on the opportunities from time to time. So you can't really pick it up. But yes, when I am talking about the 17 to 20, I am expecting at least for the next 1.5 years, the marginal increase that needs to come from pure government business being lesser in the last 2 years is something which I think we are all sure about it will happen. There is no ifs there on that part.
Okay, got it. Thank you.
Thank you. The next question is from the line of Ria from Equitas Investment. Please go ahead. Ria, you may please go ahead with your question.
Hello. Thank you for the follow-up. My question is in regards to earlier we had said that after 200 crores turnover, since it's a fixed cost business, whatever incremental revenue would come down directly to PAT levels. So why would you guide for something similar margins going forward with the 20% growth?
Sorry?
The 17 to 20% revenue growth guidance, why would you guide for a similar EBITDA margins while our post 200 crores turnover, the entire incremental revenue should ideally fall down to the bottom line?
There is also a future prospect that you are looking at, and I have been time and again saying that the digital play out, and if one is expecting 35 to 45% of the revenues to come from digital, means you'll have to invest on people, on content which will give you that digital play out, right? So that will be the play out that we will be doing, and hence exactly when we are saying the growth will come, it's not that everything will go down, because there will be some investments that you'll need to do from time to time, and that is the only percentage that will be off from the margins that we are talking about.
Okay, so more or less the current margins will sustain it.
Yeah.
Even with the incremental revenue.
Improve it, and that's the endeavor, and that's the constant endeavor from the team, and we hope that we will be able to improve margins so that that is healthy for all of us, and but we are in a juncture where there is a simultaneous investment happening for the business to be long-term perspective. So that's it's the short-term and long-term perspective in which you'll have to bear with this kind of margins. Once things get settled, hopefully yes, you can look at improvement of margins.
Got it. And in terms of digital, how much capex have we already done, and how much have we
Hardly anything. There's no capex at all right now. If at all the capex investment will happen, will happen when we are evolving technology for distribution of our content. But right now, for the scale of the business, there is zero capex, I would say, at this point in time. It's only the people-driven business that we are investing on.
And in terms of margins, how would be the digital versus our radio business?
Sorry?
In terms of margins, how would be our digital business?
Yeah, so margins will be much more as of now because there is no investment beyond people and content that we are looking, which is ingrown right now. But to answer your question, I believe my digital business will be a better EBITDA booster than my radio business, given the nature of radio, as we go forward.
Got it. Also in terms of advertisement, apart from the government, maybe we would see some increase. Which sectors do you think would keep on doing?
Auto and electrical and electronics is definitely going to grow for sure. We are also seeing a lot of pharma and healthcare, increasing in spends. In fact, this quarter, pharma and healthcare is actually the second biggest category. So we see some of these categories. Education has become big. So we believe it is going to be across categories. But yeah, to answer your question, real estate, pharma, education and auto for sure will be adding more as far as business. And as we go into the second half of the year, finance will take over and have its investments coming in.
Got it. Thank you so much for the question.
Thank you.
Thank you. A reminder to the participants, if you wish to ask a question, please press star then 1 on your touchtone telephone. Participants, if you have a question, please press star then 1 on your touchtone telephone. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference back to the management for their closing comments.
Thank you. We sincerely appreciate your participation in today's earnings call. I am confident that Radio City will continue to deliver on stakeholders' expectations and live up to the trust reposed in it. The presentation, earnings release and results are all available on the corporate website and stock exchanges. If you have any further queries, please get in touch with any one of us or with Strategic Growth Advisors or Investor Relations Partner. Stay safe, take care. Goodbye.
Thank you. On behalf of Music Broadcast, we conclude today's conference. Thank you all for joining. You may now disconnect your lines.
Please subscribe and press the bell icon to never miss another update. Please like, share and comment.